at Fundstrat, what some might say is certainly is one of the last bulls standing. The question is, Tom, is that going to change anytime soon?
Scott, I think the bull case has been really bloodied this year. It's been 3 quarters of disappointing market performance. But for reasons that we've been explaining to our clients, I think a lot of these headwinds that have been really tough on stocks, especially inflationary pressures, I think the odds are going to favor a big turn in the 4th quarter. And I heard the debate in the prior segment. I think 1982 is really an important analog. In 1982, the market's focus was almost solely inflation. And it was really when the inflation pressures broke in a way that convinced markets is when stocks bottomed. It wasn't a Fed pivot. It was really when the market viewed a pivot as being realistic. And it's a reverse checkmark rally. The market goes vertical. In fact, when people talk about unemployment rate in August was 9%. It still jumped to 11% by December, but the stock market rose 50%. I think ultimately, if inflation breaks in a way that's convincing in the next few months, you don't have to wait for the Fed pivot, and that's what we think is going to happen in the next few months.
The oft criticized Fed and their members who have been speaking publicly continue to come out and say, look, we're talking to corporate executives and leaders and board members, and they're telling us that they don't see inflation subsiding the way that you might suggest. If you look at the gas pump, okay, gas prices are down. Elsewhere, they're not coming down. Carnival today. Carnival comes out, food's up, energy's up. They can't raise their prices enough to deal with that anymore. So they have to discount, which is a hit on margins. And Nike comes out and says, we have too much inventory, and they're going to have to discount. And that's going to be a hit on gross margins. That's the real story, isn't it? Are we ignoring what's about to take place throughout corporate America and in earnings, and then how that funnels through to stock prices, Tom?
Scott, just to be clear, when Carnival's discounting, that's disinflation to the consumer. When Nike discounts, that's a disinflation to the consumer. So that's actually taking out inflationary pressures. It is correct that means earnings come down. But again, for the 82 to 90 stock market boom, which was up a 223% stock market rise, was not even earnings driven. Earnings only rose about 9% in that 8-year period. When inflationary pressures break, and I think we're still working through that, investors are going to view that as almost taking out the biggest tail risk from equity risk premia. I think that's why stocks can recover far faster than earnings, because you're now basically vanquishing the biggest threat to stock markets. So I think if inflation breaks, and I think a lot of leading indicators argue that, you're really going to create a condition for stocks to do well for quite a long time. And I think even Powell's made that same statement. We just have to defeat inflation. But again, I just think when you look at ISM prices paid or underlying inflation gauges, leading indicators, consumer UMich surveys today, inflation expectations have really improved dramatically. In fact, even Fed fund futures is below the Fed's dot plot. The market is now below where the Fed is expecting rates to be. That's a reverse where we were right after the September FOMC. So I think it's gloomy. I just think the probabilities of a lot of this coming together next 3 months is huge, and the market's reaction is going to be pretty explosive.
So margins don't matter? The only thing that matters is inflation coming down and the Fed ultimately being able to pivot off of their most aggressive and hawkish stance in decades?
Scott, markets don't bottom when PEs are low. They bottom at high PEs because earnings, the earnings sort of delivery isn't going to be on the delivered earnings. It's really the expectation of earnings. And so, yes, I'm going to make the statement that I think 1982 is still the best way to look at what will drive markets in the next few months. And it's going to be less about the E, and it's more about the PE reflecting the elimination of inflation.
The other point that I want to make that made me think of you immediately was this note today from Marko Kolanovic of JP Morgan, who has on every occasion, like you have, at moments of apparent peril, puts a note out that suggests we remain more positive. This too shall pass. Today says, quote, we're increasingly worried about central banks making a policy error and of new geopolitical tail risks following the destruction of Nord Stream, right? To me, that sounds like he's ready to throw in the towel, or at least getting awfully close. You're not swayed at all, worried that despite what you think is happening in inflation, that the Fed's not going to break something along the way?
Scott, every day that markets lose liquidity and volatility rises, the risk of an accident grows. I mean, it is a race against time that way, because we know the Fed wants to defeat inflation. They have to be very tough, and they've been stalwart, and I think markets respect it. But it's also been a difficult time for the Fed, because the delivered inflation, the hard print hasn't supported anything that would, as you're pointing out, make them at all more comfortable. So it is a race against time that way. I think there are cracks happening, in whether it's in the loan market or in European sovereign bonds. This is going to test the will of central banks. But again, I think that's why third quarter was pretty miserable. I mean, in the third quarter through mid-September, the S&P was up close to 5%, and the last 2 weeks have been utterly savage. But I think that's reflecting everything that Marco is actually pointing out.
The last thing I want to ask you about before we go is you continue to recommend to our viewers and the readers of your research mega cap tech, and it's been an awful place to be over the last month at minimum. Why is it going to get better anytime soon, given the environment that we seem to be in, and you have a lot of these stocks hitting new lows?
Well, yeah, unfortunately, mega cap tech is liquid. It's widely held, so it's a source of funds. They're going to have some sensitivity to the business cycle, whether it's ad spend or capex. But mega cap tech is the solution out of inflation. If the world is short human labor, which is really what's being exposed since the expansion, right? That's really what's driving inflation. You need to have digital human capital. I mean, that's what tech companies solve. So the U.S. is really set to become the exporter of human digital capital, or digital labor, for the next decade. I would say that that's going to be a huge earnings story. I mean, how else are we to solve labor shortage globally? And that's mega cap tech. So, I mean, it's a tough time to own it, but I'm sure you're going to have a lot of fundamental guys say, well, look, these are great stories. They just got 20% cheaper on a PE basis, or 30%, but their earnings, once we're out of this cycle, are going to grow even faster. I mean, I would be a buyer of that. So yes, again, the bulls, including us, have not really had much success this year, but there's a lot that could change, and I think it could change almost in a pivot. Just doesn't need a Fed pivot.
We'll make that the last word. Tom, I always appreciate your time. Thank you.